Welcome to Power Charting. I'm Bruce Fraser, your host. We are going to talk about the inflation nation today, but first, I have a new blog out. Go check it out. This is going to be something that I'm going to be working on for the foreseeable future, and that is campaign setups. Very exciting. If you like to find and own stocks that have the potential to go up multiple fold of what you paid for them, campaign trading and using Wyckoff tools to do it is a great methodology. I love talking about it. So we're going to write blogs, we're going to do videos and so on this topic. It's going to be a whole lot of fun. Okay, so here, the other thing we're going to do today when we talk about inflation is we're going to focus on the upward trajectory of trends when they become overbought and so on. The other part of this is talking about campaign trading is the very large accumulation structures that form prior to an important long-term uptrend in prices. And so campaign trading uses this model for the market cycle or for the stock cycle to be able to conduct our strategies, our tactics as we go forward in time. You'll see some of that today. And here is something else I want to just review with you, and that is the idea of where do you take a position in a stock. This was a great chart that we had in our class. And here is the accumulation setup. And then you have a spring and a test, or often a last point of support, which is a higher low. But a spring is a place where we look for an entry position, and there are certain characteristics of price and volume that will go along with that will help confirm this. It's the lowest price, but arguably the highest risk because prices can keep going down. Then we have a last point of support, a sign of strength and jump across the creek, a backup and an LPS, and then we're out of the accumulation range and into a new uptrend. So these are all places where we will take positions, add to our existing positions, and so on. Same thing works in reaccumulation trading ranges, which occur after a long-term uptrend. You'll get a consolidation. I think we'll see some of those today. And so here you can see that there is all of these conditions that set up at the conclusion of reaccumulation, and these are all opportunities to initiate and build positions. So here we can see the accumulation schematic with a spring at the conclusion of phase C, which is a slight break of the support area, then a test. The test is a great place to put on a position, say tranche 1. Last point of support or a pullback is tranche 2. Backup in a second LPS is tranche 3, and then the breakout of the sign of strength or the resistance area after the second last point of support becomes tranche 4. So these all become places, and guess what we're doing? We are scaling up a winning trade. We have point and figure analysis that helps us to identify how big the move can be. And so that is a great feature of this. Here's an actual example. This is from a blog, How to Determine Best Trade Entry Points, April of 2016. This is GDX Gold Miners. It's just a good example back then. January of 2016, a spring forms after an accumulation. And then look at the profound change of character in the way that the stock trades. It's just persistently up, 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 good demand all the way, and volume is expanding. So here we see the spring and a test right there, tranche 1. The backing up action here, the pause, is an LPS, very subtle, but after the LPS is a jump. that is another opportunity, two opportunities to put on a tranche. Then we jump up and out of the resistance area and we back up here. That's an LPS or a backup. That's another tranche opportunity. And then the breakout of this area becomes another one. Again, all of these are opportunities to buy on the way up. This is one of the high arts of Wyckoff. This is something we want to develop our skill drills at, because we want to get busy when the accumulation is in the final phases of structure, the final phases where it wants to go from being languishing in an accumulation trading range and go into a profound uptrending move. Best part of the uptrending move tends to be the beginning of it. And so this is a great opportunity. And also this is a great place for option traders, because I know that that's all the rage these days, but this is a great tool for option tactics. So with that in mind, let's keep going. Okay, so now we're going to talk about inflation here. I have some comments from yesterday's Fed funds meeting, and the comments from Chairman Powell, and Fed funds are going to remain unchanged between 0.25%. The Fed's going to keep buying securities at the rate of 120 billion a month. So that's QE infinity for going on and on. He said inflation pressures are expected to be transitory, and he downplayed the risk of inflation pressures building. So that's really interesting. And of course, the thing about the Fed is they really are the last ones to ever see inflation, because they don't want to see it. Because when they acknowledge inflation exists, then they have to do something about it. This chart here will help us to address this. So for financial conditions to remain accommodative and support economic activity, the Fed intends to keep going with their current policy stance. He used the F word. So for those of you with sensitive ears, he said the capital markets are a bit frothy. He used the term frothy. And so that is an acknowledgement that conditions have become somewhat excitable here with higher prices. You can see that actually on this chart. Look at how things have gone up here. That is what I think he means by frothy. And also, we are going to look at inflation beneficiaries here in a minute, because they are a measure or a condition of that frothiness. And so, but he says that the frothiness is not because of Fed policy, it's because of the vaccine regimen and the economy getting back open, and people being very excited about the economy opening back up. I guess it's giving people a capacity or an appetite for speculation. It has nothing to do with Fed policy, or maybe just a little bit to do with Fed policy. Okay, so that's what they attribute the frothiness to. The Fed is not going to be swayed by scary looking inflation numbers in the short term. So that tells us that they expect these inflation numbers to continue to ramp and get worse, and that these inflation numbers may look a little scary for a while, and the Fed's not going to do anything about it. That's basically what they're saying. So they're saying to us, for us to brace ourselves for this. Okay, so he's saying that inflation is transitory. It's not going to stick with the economy in the long run. I want to show you this chart on the Fed funds rate, because I think it tells us what we need to know about Fed policy. So if we look at this, we can see back in the 90s that rates are low for a period of time to help the economy to get back on its feet again. Once the economy gets going, interest rates can start to rise, which they did here, and the rising rates did not stop stocks from going up. And then there was a period of pausing and lowering interest rates through the middle part of the 90s. And that really actually, I believe, had a huge effect on the incredible dot-com explosion that occurred in the late part of the decade of the 90s. But notice what happens when we get up here. Look at this distributional structure, late 90s, early 2000s, is that there comes a point when the Fed starts to become more concerned with the economy slowing down, and they start to lower interest rates in earnest. And they will lower rates, and the stock market can still be in its primary bear market. And they're trying to stop that bear market. Look at this accumulation area right there. But here you can see that there's a long period of time where rates remain very low, 2002 to 2005. And then rates start to go up. Now, this is all Fed policy, and this is the yellow area. Rates are rising through the yellow area. So the Fed is actually starting to raise the Fed funds rate with rising stock prices. So this is the Fed starting to acknowledge that the economy is getting stronger and starting to heat up somewhat. Now, we just heard from Chairman Powell that there is no worry about inflation. Yes, it's transitory. We could get higher numbers here in the near term. I think he's as much as admitting that. And so he's going to be very slow to act on those inflation numbers because he doesn't believe them to be real. I don't know. I think they do believe them to be real. I just don't think they want to act on them. So here you can see that in 2009, the Great Recession, all the way to 2016, we had zero interest rate policy. And then the rates started to go up in the later part of the bull run, as you can see here. Well, there came a moment where the Fed started to worry about the economy and started to lower interest rates. And they lowered interest rates back down to the zero bound where they are now. This actually started before the COVID event. And so then we have the COVID event that comes right in here. This is about the point at which they had rates back to the zero area. Well, now the stock market is really booming again. Inflation is booming again. Commodity prices are starting to really go up, and you have interest rates at a very low level. Well, look at what has to happen for the stock market to start to have problems with higher interest rates. You have to have rates finally start to go up, and this is because Fed policy is that they're starting to snug rates and raise them up into a rising stock market, which is the yellow shaded area. We do not have that yet. We do not have the Fed even acknowledging that they're going to raise rates anytime soon. And then those rates have to go up for an extended period of time. This is 2 years right here. Actually, call it 3 years. This is 1, 2, 3.5 years. This is 1, 2, 3, 4, 5, 6.5 years. Now, I'm not saying it has to take that long, but there's going to be a period of time where rates are going to go up while the stock market's going up, and we haven't even started that process yet. And it can take maybe 2 years of rising rates to slow down or stop the stock market from going up. So we have an accommodative environment here, and we also have QE bond buying taking place. And all of these conditions together are going to result in the continuation of stocks being attractive and inflation hedges. So here is a long-term uptrending chart of lumber. Now, I know very few people trade lumber. It's a very thin market. I just want to show this to you because I think it could be telling about other inflation markets also. And so here you can see this long-term trend back to 09. It's really pretty gentle, and this is maybe a big campaign structure that we're talking about here, because look what happens. There's one last pullback into a last point of support. This could all be accumulation, and then there's a huge change of character into a massive uptrend where lumber goes from under 300 and now is at, call it 1300. So I have a friend who's building a house. He's telling me that lumber prices are going up every single week. And so, and here he is, he's right in the middle of building this house. Okay, well, what's this yellow shaded box? Well, this is an accumulation area that's 1-2 years plus that looks like it could be counted from a point and figure perspective. So let's just do that. So here's a small count here. This count, and small, I mean, it's really rather large. This count goes up to 830, and then we take that midpoint of the range here, which gives us 925. That's our objective range for the point and figure. Hit 830, missed it by one box. Went up to 820 right here. Great move. And then it pulled all the way back. I'm calling this a major sign of strength, pulled back to the top of the breakout area. I took the full count across here, 21 columns, and it gave us 1050 of count from the LPS and from the low. And this gives us an objective here, 1330 to 1500. And we went right up to 1330, touched it. Well, look here also, look at the trend channel. And we talked about that in this market cycle model that we looked at earlier. Well, here's the uptrend and up to the top of the channel, which is also an objective for lumber. Does it mean lumber's going to go down from here? Well, it might go down a little bit, but it also, because we know we have a much bigger structure over here, it's possible that lumber will go into maybe a reaccumulation structure for another move up. And so we will be watching for that, but don't be surprised if lumber, now that it's in the range of this objective, is able to pull back down to the bottom of this channel. Here is, and calling this potentially a hypodermic advance, overbought condition in the trend channel, and this would be confirmed with an automatic reaction. It's already, since this chart was printed, had a bit of a pullback. So it's already touched and pulled back from the top of this channel. But the channel that we see over here also exists on a shorter time frame here well, no, I guess it's about the same time frame. We can see that channel also developed on the vertical chart, and it is overbought and is now pausing in the area of this overbought condition. May be able to get up to the 1500 level. The automatic reaction will ultimately be the thing that will tell us that a range-bound condition is in place for lumber. A great workshop event is going to take place in May for those of you that are Wyckoff and Elliott Wave students. Dr. Pruden had a wonderful class where he synthesized Elliott Wave and Wyckoff method together into a cohesive trading approach. It's such a fun class. Well, very excited to announce that our good friend Jeffrey Kennedy, who is probably the best Elliott Wave educator alive today, and a great Elliott Wave trader and a super good guy, is going to team up with our very own Roman Bogomazov, who is also a great Wyckoff trader and educator, and they are going to do a synthesis of these two approaches together. This is going to start on May 13th. Go to wyckoffanalytics.com to see and read more about this. It's going to be such a great event. All right, so also now let's talk about something else that's very cool that is absolutely free. And this is the communal Wyckoff watch list, which is on StockCharts.com. And this is a great tool for being able to look at very interesting and timely stocks. Now, who picks these stocks? These are being selected by the Wyckoff community. All these wonderful Wyckofians, many of you are watching this episode now, have submitted charts to the communal Wyckoff watch list. And this is a very dynamic thing because we have so many of our Wyckofian minded people who are so talented out there looking at the market, scanning, studying, and seeing these best ideas, and then putting them in our communal Wyckoff watch list. And so you can go to right to the watch list up here at the top, click on that, you'll get this page, and you can go down and see what to do. There's a number of different ways that you can get this list. You can actually click on stocks here and make charts, but then the other thing you can do is go in and look at them right in StockCharts.com. And there's also a spreadsheet that you can do. So a number of ways to get at this list. It's full of great ideas. It's very interesting. So check it out. It's really cool. Back to the inflation nation. So here is CRB. This chart actually on the left, I had published on or drew it up on December 31st, but it shows you the 2020 low. This is the COVID low. It's in yellow there. You can also see a distribution structure in turquoise at the top, how beautifully they work. So that chart on the left is updated on the right through today or into today. And you can see a reaccumulation type structure here, and then it's come up and out of that area. This zone right here actually goes back to November. And so this is the July, August, September, October. So here, that whole area. So this is also a reaccumulation. Well, look where we are. So this count actually could be bigger than the one that I've taken here at the COVID low. This count goes up to 200.36, and look where we are. We're at 200 now. And so from the area of the completion of this count zone at 134, it's rallied up to 200. The count could grow larger from here, but also note that this 200 area is where prior resistance is. And so this might be a place where the CRB would find resistance, possibly go into a pause. It's fulfilled a count objective here. And so we will be watching closely to see whether or not the CRB is going to find a pause, especially now that the Fed is telling us that inflation might be a little overheated. So that's a classic top line issue headline that markets love to pause into. So here is just an example. This is XLE. This is the energy complex sector fund on the left with a point and figure count. This was done on January 6th of this year, counts up to 79 to 95. Well, here you can see that a rally up to the 53 area produced a pause. And this pause looks like a reaccumulation. You can see attempts to go down throughout this period are having reduced thrust. And that reduced thrust shows signs of accumulation here. And now all of a sudden it's attempting to turn up, work its way back up to the resistance area. And we can see that there are counts that go to much higher prices, 79 to 95 for the whole energy sector. Now, here is Exxon. Now, XLE had a yield of 4%, so it becomes a bond surrogate in this this world of zero interest rates or very low interest rates. And Exxon actually has a higher yield than that. You can see that Exxon is in a sideways reaccumulation type structure. All of a sudden it's come to life after having a test of the prior March lows. It's turning up towards the resistance area, the top of the range bound condition. This is through today. This chart over here is the accumulation area that goes into the end of the year. And so the high here is the high is $62. And you can see that that's right here for Exxon. And so that is what's taken place since we took this point and figure count across here. But note the count that we have of this area is 116 to 128. Lots of room to run. So that really does tell us, especially with what we looked at with Fed funds rate, that these Fed fund rate are so low and the Fed is not showing any signs of wanting to raise rates or tighten conditions by stopping or slowing their bond buying program, that all of the conditions that have created this inflationary pressure in CRB and lumber, in energy and so on are still there. And it's going to take a lot of work to slow down those forces. So this really does say that there is the potential for higher prices in this complex. Now let's turn our attention in the couple minutes that we have left. Here's the Dow Jones. You can see a trend channel, an attempt to throw over the trend channel here, and it's pausing. The interest rate environment that we've seen suggests that we're going to have continued pressure on speculation to drive prices higher, and that includes the stock market. Doesn't mean you can't have corrections along the way in an ongoing uptrend. So we would be opportunistic about any corrections that we see. Top of the channel here, overbought and throw over condition, but it may be able to just pause here and then accelerate. Here is the S&P. I'm going fast because we're out of time. Same condition. So you can see here an overbought throw over here for the S&P, and it's pausing here. Maybe it's got to come back into the channel. Now this is a 4-hour chart, not a daily. So it might, and so here, even with all of the great accommodative stance by the Fed, you can see that there will be periods of reaccumulation. I've actually shown you a count for the S&P of this area that counts up to 4,400-ish. So here, this is a chart of the COVID low point and figure that I did back in November. And you can see here that we have a count with a range of 4160 at the high. We're currently at 4187. So we're over the top of this. We do have some intraday counts that go a little bit higher, but that's sort of interesting. Top of the channel, fulfilling large point figure counts. We'll watch that closely. Here is the Russell. Look at what we've done here. Big, this is off these 2 points. And you can see here that a touch of this upper trend line has caused a pause in the Russell and a very extended overbought condition. Russell might need to pause here for a little bit, build up some count, but look at the relative strength here, very dynamic for the Russell. So we'll keep an eye on that and see if those trends can continue. And with that, I'm trying to turn my timer off. So here's another one. This goes back to 1942, very long trend. We're at the top of this channel also, tight range. This is the COVID 2020 low right there. So you can see it's sort of a blip on a very long-term chart. This will be an interesting one to watch too. All right, people, it's great to be here. Thanks so much for watching, and we'll see you next time on Power Charting. So long for now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.